The Federal Reserve just signaled a massive shift that could permanently rewrite the valuation of high-growth tech stocks, and if you are holding names like Tesla or Amazon without a plan, you are flying blind into a potential storm. Jerome Powell is entering his final months as chair, and the higher-for-longer mantra is colliding with a cooling labor market and new tariff pressures that are making the inflation math look incredibly messy for 2026. While the Fed is widely expected to hold rates steady at this week's meeting, the real story is in the divisions appearing behind closed doors at the Eccles Building, where a growing faction of governors is terrified that they've waited too long to cut. This isn't just about a quarter-point move, it's about the fundamental cost of capital for the companies building our future. Think about a company like Tesla. Elon Musk is out there trying to pivot from an EV manufacturer to an AI and robotics powerhouse, betting the farm on the Optimus humanoid robot and unsupervised full self-driving. But these are capital-intensive moonshots that require cheap debt and high investor risk tolerance. When the Fed signals they might only give us 1 or 2 rate cuts for the entire year of 2026, the market starts to reevaluate how much it's willing to pay for a dream that might not cash flow for another 5 years. Here at MoneyFacts USA, we've been tracking the correlation between these Fed dot plots and Musk's net worth, and the volatility we're seeing right now is a direct reflection of this interest rate tug-of-war. The story gets even more interesting when you look at SpaceX. Rumors are swirling on Wall Street about a massive 2026 IPO that could seek a valuation of $1.5 trillion. If that happens, it would be the largest listing in history, but its success depends entirely on the liquidity environment the Fed creates over the next 6 months. You see, high-growth tech thrives in a Goldilocks economy, not too hot to spark inflation, but not too cold to kill growth. Right now, with gold hitting record highs over $5,000 an ounce and the dollar sliding against the yen, investors are screaming for safety. They are questioning whether the Magnificent Seven can continue to carry the S&P 500 when the cost of borrowing stays pinned near 4%. I want you to look at your portfolio for a second and ask yourself if you're positioned for a pause or a pivot. Most retail investors are still trading on 2024 logic, thinking that the Fed will always come to the rescue the moment the Nasdaq dips. But the 2026 reality is different because of the looming change in Fed leadership. With names like Rick Rieder being floated as potential successors to Powell, we might be looking at a much more hawkish Federal Reserve that prioritizes a strong dollar over a stock market rally. Money facts. USA is seeing a rotation out of pure growth and into the belly of the yield curve as smart money prepares for a year of sideways movement rather than a vertical breakout. Elon Musk recently said that Tesla's autonomy timeline is the difference between the company being worth $10 trillion or almost nothing. That's a bold claim, but even he can't fight the gravity of the Federal Reserve. Every time a Fed official hints at sticky inflation, the discount rate applied to Tesla's future earnings goes up, and the stock price takes a hit. We saw it this week as investors de-risked ahead of earnings, pulling capital out of tech and moving it into rare earths and commodities. It's a classic defensive play, and it's one you should be watching closely if you want to protect your wealth in this shifting landscape. This brings us to the broader tech sector, specifically the AI trade. For the last 2 years, companies like Microsoft and Meta have been spending tens of billions on H100 chips and data centers, promising a massive return on investment. But the market's patience is wearing thin. You're hearing a lot of noise right now about soft landings and no landings, but at MoneyFacts USA, we believe in looking at the raw data. This puts the Fed in a dual mandate nightmare. If they cut rates to save jobs, they risk an inflation spike from new tariffs. If they hold rates to kill inflation, they might push the U.S. consumer off a cliff. For tech investors, this means the era of easy money is officially over, and the era of execution has begun. Ultimately, your strategy for 2026 needs to be about resilience. Don't get blinded by the celebrity status of tech CEOs or the hype of the latest robo-taxi announcement. Pay attention to the bond market and the messaging coming out of the FOMC. The Fed is the most powerful force in your financial life, and right now, they are sending a clear signal that the rules of the game have changed.